Good morning, all of you. We are starting with the topic of CAPM, Capital Asset Pricing Model. In this model, we can calculate the expected return of a particular stock. Expected return of a particular stock we can calculate. And we are getting a compensation of a risk. जब हम रिस्क ले रहे हैं तो उसका compensation यानी reward भी हमें चाहिए. Whenever an investor is taking a risk, he want to be compensated with the reward. And CAPM will calculate the expected return of the stock. So when you are avoiding fixed deposits, when you are ignoring fixed deposits and you are investing into stocks, investor is taking additional risk by investing his amount not in FD but in stocks like shares, okay, shares of very good companies, okay. So you are taking additional risk, and there is a component called beta. Beta will measure how much risk you are taking when you compare with market. Okay, when you look at the market and when you look at your stock, you are comparing your stock with the market. That is called as beta component. Beta is always measured in times. What return you are getting on your stock and what return market is giving to index funds, okay. In index funds, they are earning similar returns of market. So I have given you data something related to beta greater than 1, beta less than 1. Beta greater than 1 is very risky. That means you are beating the market. You are riskier than market. अब मार्केट से भी ज्यादा रिस्की हो आपके स्टॉक का, जहां पे आप इन्वेस्टमेंट कर रहे हो उसका बीटा अगर 1 से ज्यादा है, यानी वो मार्केट से भी बहुत ज्यादा फ्लक्चुएशंस करेगा. अगर बीटा लेस देन 1 है, बीटा if it is less than 1, then the stock is less riskier than the market. यानी मार्केट बहुत जल्दी जल्दी चेंज होगा लेकिन स्टॉक धीरे धीरे चेंजेस करेगा. Stock is not risky than the market. Market is more risky. बीटा अगर लेस देन 1 हो गया, इसका मतलब मार्केट ज्यादा फ्लक्चुएट करेगा लेकिन आपका स्टॉक इतना फ्लक्चुएट नहीं करता है जितना मार्केट कर रहा है. तो बीटा से हम वोलेटिलिटी मेजर करते हैं. बीटा इज मेजरमेंट ऑफ वोलेटिलिटी of a particular stock with respect to the market. Okay, so when Nifty is going up by 20%, where is my stock going up? Whether it is going up or down. When Nifty is going up by 20%, my stock is going up by only 10%. So beta is 0.5. Half only. I'm getting half returns compared to Nifty. So CAPM is a stock beta multiplied by market risk premium. You can find here the risk-free return and the RM in the bracket. Okay, RM minus RF is what? Market risk premium. And when you multiply with the beta, you will get the return expectation from the market above the risk-free rate. Why we are adding risk-free rate? Because RF प्लस करने के बाद आपको जो रिस्क लिया है, एक्स्ट्रा रिस्क, उसका एडिशनल प्रॉफिट भी आपको चाहिए. प्लीज क्लोज द वीडियो, प्रकृति शाह. Okay, risk-free rate is then added to the product of stock beta and the market risk premium. CAPM will give an investor a required return or discount rate they can use to find the value of an asset. So investor is taking additional risk by investing into the stocks. Okay, and the goal of CAPM is to evaluate whether a stock is overvalued, fairly valued, when its risk and the time value of money are compared to its expected return. सबसे पहले आपको बीटा का फॉर्मूला आना चाहिए, कोवेरियंस ऑफ स्टॉक एंड मार्केट डिवाइड बाय वेरियंस ऑफ मार्केट. After calculating beta, you should find out what is the return we are getting on government securities. You have to search on Google what is the return on GSEC, government security. That is your risk-free rate. Okay. Once you have calculated beta and risk-free rate, you have searched from the Google. Treasury bill rate, that is also risk-free rate. After that, you have to calculate the average return which you are getting on the market. Average return can be of 5 years or 1 year. Okay. That average return you have to deduct from the risk-free rate. Now these are 3 portfolios, and this portfolio have asset allocation with the risky asset and less risky asset. All the portfolios have risky asset and less risky asset, risky asset and less risky asset. Why we combine risky asset with less risky asset? Because somewhere we are getting guaranteed returns and somewhere the returns are uncertain. So we like both the things, uncertainty in returns. If you are young investor, you would like to take risk. So risky asset where you are not getting certain returns. You are getting uncertain returns. Less risky assets are fixed deposits, national savings certificate, public provident fund. Okay, so after making portfolios, what you will check? Standard deviation of all the 3 portfolios. Okay, standard deviation you will check of all the 3 portfolios. This is the graphical portfolio combinations. This is a capital market line. If you touch this particular line, that will be ideal market portfolio. Your returns should grow like this. From the risk-free rate, above the risk-free rate, you should get some returns because you are investing in stocks. So you should get above GSEC returns. So you should get capital market line like this. Expected return on the y-axis. On x-axis, the expected risk. This is an efficient frontier. Okay. And these are the different portfolio combinations in circle. Light green is portfolio combinations. Some portfolios are giving high returns, but they have very high risk. Some portfolios are having high returns, but lower risk. Okay. You can take example of this. Here the risk and return. You are touching this line, particular line. So these all are inferior portfolios and individual assets because these circles are not touching this particular line. The circle which is touching this particular line is ideal portfolio. This is a good portfolio because you have less risk. You can see here the risk in this portfolio is very less, but the return is comparatively high compared to these portfolios. Here you are taking so much risk, but you are getting this much return. You are taking so much risk. Here also you are taking so much risk, but you are getting only this much. But if you compare this portfolio with these portfolio 1, 2, 3, okay, 1, 2, 3, you are comparing with this dark green. This portfolio is having very less risk, but return is comparatively high. Okay, so this is the ideal market portfolio. This graph shows expected returns on y-axis, risk on x-axis. Above the risk-free rate, all the market investors want to earn above the risk-free rate. As the risk increases, they want high returns. Any portfolio that fits on CML line, capital market line, is better than any possible portfolio to the right of that line. If you touch this particular line, capital market line, that portfolio will be ideal portfolio. There is a trade-off between return and the risk. It is not possible to perfectly build a portfolio that fits on CML. It is more common for investors to take on too much risk as they seek additional return. So when investors are taking high risk, they are expecting high returns. What is the name of modern portfolio theory? What are the other names of modern portfolio theory? Markowitz model, mean variance analysis model. Second, fill up. Higher the risk, dash the return. If you are taking high risk, you are expecting higher return. What is the full form of CAPM? Capital Asset Pricing Model. What is the formula of CAPM? E of R, expected return of the stock, is equals to RF plus. You want to earn above risk-free rate, above GSEC, so RF plus beta multiplied by RM minus RF in the bracket. What is the risk premium? When I'm investing in a stock, I'm taking a very high risk and I'm expecting a very good returns. So because of this high risk taking, I'm expecting a risk premium from the investment, that is RM minus RF. So this bracket is called as risk premium. This bracket is called as risk premium. Next question, what is the range of return? When you add or less standard deviation from the expected return, you will get range of return. If you have 10% expected return, standard deviation is 5. You will add 5 first and then you will less 5 minus 5 from this. 10 minus 5, you will get 5%. 10 plus 5, 15%. So you will get returns in the range of 5 to 15% in this particular stock. Next question is, what is the limit of correlation and coefficient? Always when you calculate correlation and coefficient, that is covariance of stock and market divided by standard deviation of stock and standard deviation of market, multiply standard deviation with standard deviation of stock market in the denominator, you will get correlation and it will be always in the range of -1 to 1. In between this, you will get the answer. What is the formula of correlation coefficient of stock X and Y? Covariance of stock X and Y divided by standard deviation of X into standard deviation of Y. With this formula, covariance you can calculate stock X return minus expected return into stock Y return minus expected return, that is mean return, bracket close into probability divided by standard deviation Rx minus Rx bar square into P, that means standard deviation of X. With this formula you can calculate. Next, square root Ry minus E of Ry square into probability. You will get the standard deviation of Y. So standard deviation of X into standard deviation of Y will be written in the denominator. First, numerator is covariance and denominator is X and Y standard deviation. You can multiply.